last week, we got the news that the Teamsters had reached an agreement with UPS for substantial wage hikes over the next 5 years. I'm not sure the full-time. I didn't see the exact number for them, but I saw the part-time workers, part-time drivers for UPS, and they're basically getting a 10% raise per year. It was 9 point something, but rounds it up to 10%. 10% per year for the next 5 years. 10% increases. What does that tell you? I mean, it's not that these wage hikes are going to cause the inflation. The point is the inflation has resulted in these wage hikes. Again, during the Q&A portion of the press conference, a lot of the reporters asked Powell about if he was worried that rising wages would be a problem for inflation and wage inflation, or would rising food prices be a problem creating inflation. And all these questions are being asked by people who don't understand inflation, and they're being asked of a Fed chairman who doesn't understand inflation, because inflation is not caused by wages going up. Inflation is not caused by food prices going up. It's inflation that causes wages to rise. It's inflation that causes food prices to rise. That's what's going on. Now, food prices could rise for other reasons other than inflation, but if food prices rise, absent inflation, the price of something else is going to go down. So rising prices won't cause inflation. It's inflation that causes all prices to rise, and that's what's happening. But you can't overlook what's going on. These 10% per year increase in wages for UPS, what is this telling you? This is telling you that shipping costs are going to go way up, not just the wage component, but a lot of other factors. And if UPS is giving its drivers these big hikes, FedEx is going to do the same thing. The cost of shipping everything is going to go way up. Well, what are these companies going to do? If companies are having to pay higher prices to ship their products, well, what are they going to do? They're going to pass that on to their customers. All this stuff is going to be passed on. And of course, the individual consumer, when they finally get their products, they're going to pay another shipping cost, right, to get it to themselves. So there are tremendous inflation pressures that are building. You can see it, right? You can see the impact inflation is having on wages, on other costs, and the Fed is oblivious. Yes, Powell is saying we still see inflation as a threat, but at the same time, he's promising to cut rates next year in the face of that threat, saying that we don't want to be optimistic. In fact, somebody asked him, if he's optimistic, and Powell said, well, I wouldn't want to say I'm optimistic. Let's just say I see a pathway, meaning getting to 2% inflation. Well, I mean, he's obviously optimistic if he's forecasting rate cuts next year, and then he's admitting that the Fed's going to start cutting rates long before. He said long before we get to 2%, not just before 2%. He said long before we get to 2%, we're going to start cutting rates. Why? Why don't you wait till we get 2%? In fact, he should wait for under 2% to really make sure that we get down there. Because if he just wants to assume that 2.5% is going to become 2%, and so he just starts cutting interest rates, on the come, because he just believes that the 2.5% inflation is going to go down to 2. And what if all of a sudden it goes the other way, right? What if the fire is starting to, go out, and then he throws gasoline on it and it ignites all over again? It makes no sense for a Fed chairman who really is concerned about inflation to be talking about cutting rates next year. What Powell should be saying is there are no rate cuts anywhere in sight. Maybe we're going to stop hiking at 5.5, but rates are going to have to be at 5.5 indefinitely. After all, this is where rates were, 20 years ago, 25, 30 years ago. This was normal. A 5%, 5.25%, 5.5% Fed funds rate is not low. Historically, if you go back ever since we've been off the gold standard, but certainly if you go back to the 1970s, 1980s, 1990s, the rate we have right now is not high. It's kind of average to low. So why would Powell be promising a return to the very artificially low interest rates that caused all this inflation in the first place? The reason inflation broke out to the highest level since the 1970s is because we kept interest rates so low for so long. Why would Powell be talking about returning to those very policies that created the problem that the Fed is now struggling with? Because Powell cannot be honest with the markets. Because if Powell actually told the markets the truth that high interest rates are here to stay, the markets would crash. There's no doubt in my mind that that's what would happen. And the reason the markets haven't crashed is because Powell continues to suggest, not only suggest, to say, to reassure the markets that it doesn't matter whether we hike rates again in September, because by next year we're cutting rates. So don't worry. This is all temporary. The pain is going to go away. We've got relief coming. Well, the pain's not going to go away. The pain is actually going to get worse. Now, I wanted to talk about some of the other data points that came out during the week, because on Thursday, we got some strong economic data that actually sent the price of gold tumbling about $27, although it recovered about half those gains the following day on Friday. But the GDP numbers came out for Q2. This is the initial estimate. And I was surprised by this number. The consensus was for up 1.5%, and that was a decline from the 2% from the first quarter. And instead, we got 2.4%, which is a big number. I mean, not big in, absolute terms, but relative to expectations. In fact, the consensus forecast was for a rise of between 0.3 and 2.2. So we came out above the upper end. And the personal consumption expenditures, that was only a tad hotter than expected. They were looking at 1.5, which was a big decline from the 4.2 from Q1. But we got 1.6. But that really spooked the markets. That also caused a massive sell-off in the bond market that day. So bonds got clobbered. It also caused a big rally in the dollar. The stock market initially shrugged it off. I was kind of surprised. Early in the day, the Dow was up better than 100 points, despite the bloodshed in the bond market and what was going on. But by the end of the day, the Dow had surrendered those gains. I think it was down a little over 200 points on the day. That's the day that we broke that 13-day winning streak. We got the trade deficit, again, a snore. Nobody talks about it. This is the trade deficit in goods. It wasn't quite as horrific as the consensus forecast of 91.8 billion, but it was 87.8 billion, which was a huge number. And the reason that we got this was because imports dropped, actually. The imports were down 1.4%, maybe because the American consumer is pretty much tapped out and has a lot, they've already, depleted their savings. And so imports were down a bit. Exports were also up slightly, 0.2. And that's why the trade deficit narrowed a bit in goods, but it's still horrific. And again, this is merchandise, 87.8 billion. The merchandise trade deficit that caused, I think, was the one that was the straw that broke the camel's back, that caused the 1987 stock market crash, or was one of the main causes, was the $17 billion deficit. So 17 billion was such a scary number, and now the market doesn't even care about $88 billion. So these are horrific deficits that are going to be a big deal very soon. Again, it doesn't matter until it matters. But we got, more negative economic news. We got the Chicago Fed national activity. These numbers continue to be very weak. Last month, it was in May, rather, it was minus 0.15. That was revised to minus 0.28, so a worse number. The forecast for June was positive 0.3. It came out as negative 0.32. So according to Chicago Fed, basically, it looks like recession is coming, or here. The PMI came out for June. This one was actually above 50, so slight growth at 52. But manufacturing is still in the red at just 49. So that's in contraction in manufacturing. The service sector was slightly, positive at 52. Durable goods, that also came out on Thursday. That was another stronger number that helped cause the carnage in the bond market and the sell-off in gold, because the number was positive 4.7, and that was versus a consensus of up 0.5. So a big number. And ex-transportation, it was supposed to be down 0.1. It came out at up 0.6. So this was a number that was stronger than expected and contributed to what happened in the market. But again, if you look at the chart, the bond market looks horrific. I mean, we had a little bit of a rally on Friday, and the yield on the 10-year just back below 4%, 3.97. But the 5-year is almost 4.2, and even the 30-year is 4.03. But if you look at these charts, it looks to me like we're going to be breaking down in the bond market, and how much longer the stock market can ignore the breakdown of the bond market. There's a lot of people that have been looking for a big rally in the bond market. A lot of people have been saying, buy treasuries, lock in these yields. And I've been warning people not to buy treasuries. In fact, again, I was on Fox Business. That was the day before I left Connecticut for Arizona. I went into the studio and I was with Liz Clayman. The guy that was on there with me was recommending treasuries. A lot of people, the bond king, right? Jeff Gundlach I've been watching him on CNBC, touting treasuries, buy these bonds, lock in these yields. He's been saying this. A lot of people have been recommending bonds because they think this is you're locking in these high yields. They're not high. These yields are still low, especially when you contrast them to the rate of inflation. But I think we're getting ready to disappoint a lot of people who have been trying to pick the bottom in the bond market and who have been buying the 10-year or longer, thinking they're going to make a gain. They're about to get hit with some unexpected losses. And not only is this going to be a problem for the people who buy the bonds, it's going to be a big problem for the banks, because the banks are about to get another leg down in their portfolios, because their bond portfolios, their mortgage portfolios are about to take another big hit when we get another leg down in the bond market. And that's going to be a big problem. It's a big problem for the Fed too, because now the Fed has to bail these banks out by doing quantitative easing. During the Q&A, Powell actually got a question. Somebody said, you're going to start cutting rates, right, by next year. Is it possible that you're still going to be doing quantitative tightening, right? Because the Fed is still committed to shrinking its balance sheet, yet they just said they're going to start cutting rates next year. And so this reporter said, well, are you going to be cutting rates while you're still doing quantitative tightening? And Powell's response was, yeah, that could be, right? Because he doesn't want to acknowledge that they're going to go back to quantitative easing next year, but that's exactly what he's going to do. In fact, I actually think that the Fed's going to go back to QE before it starts cutting rates. I think it's going to be forced to go back to QE to bail out the banks based on the next leg down in the bond market and the mortgage-backed security market. But also, it's going to have to bail out the U.S. government, because more and more of this debt is maturing and the Fed is having to go into the bond market and finance it at current rates. There are no buyers there. The world doesn't want to loan us all this money. And so the Fed is not just the lender of last resort, it's the lender of only resort. And the only way the Fed can lend to the US government is by going back to quantitative easing. So I would expect that to happen even before the Fed starts hiking rates.